Welcome back to the Brewing Trades Podcast. This is episode 5, and we're diving into 2 powerful tools for traders that can elevate your strategy. First up, we'll explore time cycles, how understanding repetitive patterns in the market can help you time your entries and exits more effectively, especially in futures and forex trading. We'll break down daily, weekly, and even seasonal cycles that can impact price action. Then, we'll shift to market sentiment analysis. We'll look at how to read the collective mood of the market, spot when trends are reaching extremes, and use sentiment to identify potential reversals or confirm trends. So, get comfortable, and let's dive deep into the world of time cycles and market sentiment. Maya and Remus.
Welcome back, everybody. I'm so excited for this deep dive. We're tackling a topic that can really take your trading to the next level. Time cycles.
Time cycle.
Yeah, these recurring patterns in the market that are like hidden clues.
Right, and once you start to recognize these patterns, you can anticipate market moves instead of just reacting to them.
Exactly. It's like having a sneak peek into the future of the market. But before we get ahead of ourselves, let's start with the basics. What exactly are time cycles?
So time cycles are essentially recurring patterns in market behavior. They can be influenced by a bunch of things: economic data, geopolitical events, even just seasonal demand.
So kind of like how the leaves change color every fall, but instead of trees, we're looking at like stocks and currencies.
Exactly. It's that same idea of a predictable rhythm. But instead of nature, we're looking at the financial market.
Okay, that makes sense. So it's not like a guaranteed crystal ball, but more like a powerful indicator that can help you make smarter trades.
Right. It's all about probabilities and improving your odds.
Okay, so let's break down some of these time cycles, starting with the ones that play out within a single trading day. What do you call those again?
Those are called intraday cycles, and they're especially important for traders who are looking to make quick profits.
Got it. So we're talking about those super short-term opportunities.
Exactly. Now think about the forex market. It's open 24 hours a day, right?
Right, which means there's always action happening somewhere.
Exactly. And different parts of the world bring their own energy to the market as their trading day begins.
Like the London session, I've heard that one is crazy volatile.
It is, especially when it overlaps with the New York session. You've got tons of traders active during that time, so there's massive liquidity, and that can lead to some really big price swings.
So it's not just about being in the market, but about being in the market at the right time.
Exactly. And that's true even within a single trading session. Certain hours, like when the London and New York sessions open, consistently see these spikes in volatility.
So if I'm a forex trader, I need to have my coffee ready and be glued to my screen during those times.
Pretty much. Now, another thing to keep in mind is the impact of news releases.
Oh, yeah. Those can really shake things up.
Definitely. Think about a major economic announcement like the U.S. non-farm payroll report. Everybody is watching that, and the market reaction is usually huge and almost instantaneous.
It's like waiting for a bomb to go off.
Yeah.
It's coming, but you have no idea how big the explosion will be.
That's a great analogy.
Yeah.
And knowing when those announcements are scheduled can be the difference between making a profit and getting caught in the blast.
So if I know it's coming, I could either prepare for the volatility or just stay out of the market completely.
Exactly. Risk management is key, especially around those high impact events.
Okay, so we've covered the daily and intraday cycles. But what about those patterns that play out over a longer time frame? Like what happens on a weekly basis?
Well, one of the most well-known weekly patterns is the Monday gap.
Oh, yeah, I've heard of that one. What causes it again?
It's all about those weekend events. If there's some big news over the weekend, the market might open on Monday with a significant price gap from where it closed on Friday. It's basically playing catch up.
I see. So like if a company announces some big news over the weekend, its stock price might jump up or down when the market opens on Monday.
Right. And these gaps can create both risks and opportunities for traders.
And then there's the Friday afternoon effect, right?
Exactly. You often see increased volatility on Fridays as traders square up their positions before the weekend.
So they're either closing out their trades to lock in profits or cutting their losses before things get worse over the weekend.
Right. It's all about managing risk and going into the weekend with a clean slate.
So it sounds like Fridays can be pretty hectic in the markets.
They can be. Now let's switch gears and talk about commodities because they often have their own unique weekly cycles that are tied to inventory reports.
Oh, right. I've heard about that. So like with oil, there's that big report that comes out every Wednesday.
Okay. Exactly. The EIA oil report. And that report can have a huge influence on oil prices because it tells us about supply and demand.
It's like knowing when your favorite store is restocking. You can get there early and get the best deals.
That's a great way to think about it. By tracking these reports, you can anticipate those potential price swings and adjust your trading accordingly.
Okay, this is making a lot of sense. So we've got these short-term cycles, daily and weekly. But what about the bigger picture? What about the monthly and quarterly cycles?
Right. Well, that's where we start to see the influence of the big players.
The big players.
Yeah, institutions, hedge funds, those guys.
Okay, so we're talking about the whales of the financial world.
Exactly. They often rebalance their portfolios at the end of the month or quarter, and that can create some pretty significant waves in the market.
So like everyone is trying to adjust their positions at the same time, and it causes these predictable spikes in activity.
Exactly. And these rebalancing events can impact specific sectors or asset classes more than others. For instance, you might see more volatility in tech stocks or emerging market currencies during these periods.
Interesting. So it's not just about knowing that end of month or end of quarter rebalancing is happening, but also understanding which parts of the market are most likely to be affected.
Right. You got to be specific. Now, on top of that, we can't forget about central bank meetings.
Oh, yeah. Those are always a big deal.
They are. They tend to occur on a monthly or quarterly basis, and those interest rate announcements can really send currencies on a roller coaster ride.
It's like everyone is holding their breath, waiting to see what the central bank is going to do.
And you can see those expectations reflected in the currency's value in the days and weeks leading up to the announcement.
So even before the actual decision is made, the market is already pricing in the possibilities.
Absolutely. And then when the announcement is finally made, you often see a surge in volatility as the market digests the news and adjusts accordingly.
So it's almost like there are two waves of opportunity. One leading up to the announcement as expectations are being built, and then another one right after the announcement as the market reacts.
You got it. Now, remember those seasonal trends we discussed earlier?
The ones about heating oil going up in the winter and stuff.
Right. Well, those really come into play with monthly and quarterly cycles, especially for commodities. Think about heating oil in winter, for instance.
Right. Demand goes up and so does the price. Makes sense.
It does, but here's where it gets interesting. By analyzing historical price data, you can start to pinpoint the exact weeks or even days when those price spikes are most likely to occur.
So it's not just about knowing that heating oil prices tend to rise in winter, but about knowing when in winter to expect those biggest moves. That's a serious edge.
Exactly. Now, are you ready to zoom out even further?
Let's do it. What's next?
Annual and seasonal cycles.
Okay, so now we're talking about those really long-term patterns.
Exactly. And one that you might have heard of is the Santa Claus rally.
Oh, yeah. I've heard that term thrown around, but I'm not really sure what it means.
Well, it refers to the tendency for the stock market to perform well in the last few weeks of December and the first few days of January.
So is there like a reason for that, or is it just a coincidence?
There are a few theories. Some believe it's driven by holiday spending and optimism, while others attribute it to year-end portfolio adjustments by institutional investors.
So could be a bit of both?
Possibly. Like with most things in the market, there are multiple factors at play.
So even though it's not a guaranteed thing, the Santa Claus rally is something to keep an eye on.
Definitely. Now, another example of an annual cycle is the seasonal behavior of commodities.
Oh, right. We talked about natural gas rising in the winter because of heating demand.
Exactly. Well, agricultural futures also have their own unique cycles that are tied to planting and harvesting seasons.
So if I'm trading corn futures, I need to pay attention to what's happening on the farms in the Midwest.
Right. Those seasonal cycles can have a major impact on supply and demand, which of course drives prices.
Okay, so we've covered everything from those super fast intraday cycles to these longer term seasonal and annual patterns. Now, what about the really big picture stuff, the long-term economic and business cycles?
Ah, yes. Those are the cycles that can really shape the entire landscape for investors and traders for years, even decades.
So we're talking about the really big waves that we need to ride.
Exactly.
So if I can understand these cycles, I can ride those big waves of economic growth and contraction.
Precisely. Business cycles typically move through these phases, expansion, peak, contraction, and recovery. And during each phase, different asset classes tend to perform better than others.
So like during a recession, I've heard that gold tends to do well because it's seen as a safe haven.
That's a perfect example. During times of economic uncertainty, investors often flock to safe havens like gold or the US dollar, while riskier assets like stocks or emerging market currencies tend to underperform.
So by understanding where we are in the economic cycle, I could adjust my portfolio accordingly.
Exactly. You can shift towards more conservative assets during periods of contraction and then rotate back into riskier assets as the economy starts to recover.
It's like navigating a ship through different weather conditions. You need to adjust your sails based on the prevailing winds.
I like that analogy. Now, closely tied to business cycles are interest rate cycles.
Oh, right, because central banks are always tinkering with interest rates.
They are central banks like the Federal Reserve or the European Central Bank are constantly adjusting interest rates to try to manage inflation and economic growth.
And those decisions can have a huge impact on currencies, right?
Absolutely. When interest rates rise in one country, it tends to attract foreign investment, which boosts the value of that country's currency.
So if I can anticipate which way interest rates are heading, I could potentially profit by trading currencies.
That's the idea. Now, identifying these long-term cycles can be a bit more challenging because they unfold over years, even decades.
So it's not as simple as looking at a chart and spotting a repeating pattern.
Right. It requires careful analysis of economic data and understanding of global trends, and even a bit of intuition. But once you start to see those big cycles at play, it can be incredibly insightful.
This is all so fascinating, but I'm also thinking about the practical side. We've talked about all these different time cycles, but how can traders actually incorporate this knowledge into their strategies?
Yeah.
I mean, how do you actually use this stuff to make trading decisions?
Well, it all starts with understanding the specific cycle you're looking at. Let's start with those intraday cycles.
Okay, so like those short-term moves that happen within a single trading day.
Exactly. If you're a forex trader who's into scalping, for example.
Scalping.
Yeah, those quick in and out trades.
Got it.
Well, knowing that the London-New York overlap creates this heightened volatility.
Right, we talked about that.
Yeah, well, that knowledge could help you focus your trading during those specific hours. That's when you're most likely to see those quick price movements that scalpers love.
So it's all about understanding the personality of each trading session and adapting your approach accordingly.
Exactly. Now, let's say you're more of a swing trader. You like to hold positions for a few days or even weeks.
Right, more of a long-term approach.
Yeah, well, you might use those weekly cycles to your advantage. Like, remember the Monday gap we talked about?
Yeah, where the market opens with a jump because of something that happened over the weekend.
Exactly. Well, there are specific technical indicators and chart patterns that can help you identify potential trading opportunities created by those gaps.
So it's not just about knowing that the gap exists, but about understanding how to use it to your advantage.
Right. You might look for a gap that coincides with a breakout from a key resistance level, for instance. That could suggest a potential continuation of the upward trend.
So the time cycle gives you the context, and then you use your technical analysis skills to pinpoint those exact entry and exit points.
Precisely. It's all about combining different pieces of information to make informed trading decisions.
Okay, that makes sense. Now, what about those high-impact news releases? How can traders prepare for those?
Well, one way is to use options contracts. They can be a really powerful tool for managing risk around those events.
I've heard of options, but I'm not really sure how they work.
Well, in a nutshell, options give you the right, but not the obligation, to buy or sell an asset at a specific price within a specific time frame. So let's say you think a certain stock is going to make a big move after an earnings announcement.
Right.
You could buy a straddle, which means you're buying both a call option and a put option with the same strike price and expiration date.
So you're basically betting on the stock moving significantly in either direction.
Exactly. It doesn't matter whether the market gaps up or down after the announcement, you're covered either way.
That's a clever way to manage risk around those uncertain events.
It is. Now, what about those end of month and end of quarter cycles? Remember how we talked about institutional investors rebalancing their portfolios?
Yeah, that was interesting.
Well, one approach is to try to identify sectors or asset classes that are historically prone to large moves during those periods.
So you're looking for patterns in how those big players behave.
Exactly. Let's say you notice that small cap stocks tend to outperform in the last week of each quarter. You might consider buying a small cap ETF a few days before the quarter ends and then selling it once the rebalancing is complete.
So you're essentially riding the wave of those institutional money flows.
Right. It's all about understanding the market dynamics and positioning yourself accordingly.
Okay, now let's talk about those seasonal commodity trades. We touched on that earlier, but I'd love to hear more about how traders actually capitalize on those patterns.
Well, there's a whole world of strategies around those. For instance, let's say you're trading cocoa futures. Knowing that the harvests in West Africa typically peak in October can help you anticipate price fluctuations.
So you could look to buy cocoa futures in anticipation of a price dip after the harvest when supply is high.
Exactly. And then you could aim to sell those futures as the price recovers in the months leading up to the next harvest.
If you like a seasonal arbitrage opportunity. Buy low, sell high, based on those predictable patterns.
That's the idea. Now, when it comes to those long-term economic and business cycles, well, those require a bit of a different approach. It's less about pinpointing specific entry and exit points and more about adjusting your overall portfolio allocation based on the prevailing economic winds.
So you're thinking about the big picture and trying to position yourself for those long-term trends.
Exactly. If you think the economy is heading into a recession, you might shift a larger portion of your portfolio to more conservative assets like bonds or gold.
To protect your capital during those turbulent times.
Right. And then as the economy starts to recover, you can gradually rotate back into stocks or other growth-oriented assets.
So it's all about adapting to those changing conditions.
Exactly. You got to be flexible in the markets.
Yeah.
Now remember, time cycles are just one piece of the puzzle. You always want to combine this analysis with other tools like fundamental analysis, technical analysis, and of course, good risk management.
Right. It's like having multiple layers of protection.
Exactly. You're not putting all your eggs in one basket. And it's important to remember that time cycles are not foolproof. Markets can be unpredictable, and there will always be events that defy even the most well-established patterns.
So we always need to stay humble and be prepared to adapt.
Absolutely. You always want to be prepared to adjust your strategy if the market throws you a curveball. That's part of the game.
This has been an incredibly insightful deep dive. I feel like I have a whole new set of tools to help me navigate the markets.
I'm glad to hear that. Remember, the market is a complex system, but by understanding the rhythms and cycles that influence its behavior, you can gain a significant edge.
So to all our listeners out there, it's time to start spotting those cycles and putting this knowledge to work. Happy trading.
And that's the beauty of it, right? You're constantly learning and adapting and refining your approach.
So it's not just about memorizing a bunch of patterns. It's about understanding the underlying forces that drive those patterns.
Exactly. You need to be able to connect the dots, see the bigger picture, and that's what separates the successful traders from the rest.
Okay, so we've talked about the theory. Now let's get down to brass tacks. Can you give me some specific examples of how traders can use this knowledge of time cycles to make money?
Sure. Let's say you're interested in trading the EUR-USD currency pair.
Okay, one of the most popular ones.
Right. Well, one thing you could do is pay close attention to the announcements from the European Central Bank.
The ECB.
Yeah, those announcements can have a huge impact on the value of the euro.
Right, because they're setting interest rates and all that.
Exactly. So you could look at the historical data, see how the EUR-USD has reacted to past ECB announcements, and then use that information to anticipate how it might react to future announcements.
So you're basically looking for patterns in how the market has responded in the past.
Right. And that can give you an edge in your trading.
Okay, that makes sense. Now, what about something like natural gas?
Well, natural gas is a great example of a commodity that's heavily influenced by seasonal factors.
Because of heating demand in the winter.
Exactly. So you could look at the historical data for natural gas futures contracts.
Futures contract?
Yeah, those are agreements to buy or sell natural gas at a specific price on a specific date in the future.
Got it.
So you could look at the historical data for natural gas futures and see how prices have tended to move during different times of the year.
So you could see when prices typically peak and when they typically bottom out.
Right. And then you could use that information to time your trades accordingly.
So you might buy natural gas futures in the fall when prices are typically low.
Right. And then sell them in the winter when prices are typically high.
Buy low, sell high. The classic strategy.
Exactly. It's all about timing the market correctly.
Now, what about something like gold? I know a lot of people consider gold to be a safe haven asset.
It is. And it's interesting to see how gold prices tend to move during times of economic uncertainty.
So like during a recession.
Exactly. When investors are worried about the economy, they often flock to gold as a way to protect their wealth.
Because it's seen as a stable store of value.
Right. So you could look at the historical data for gold prices and see how they've correlated with economic indicators like GDP growth or unemployment.
So if you see signs that a recession is on the horizon, you might consider buying gold.
Exactly. It's all about anticipating those shifts in investor sentiment.
Okay, this is all really fascinating. I feel like I'm starting to see how these time cycles can be used in so many different ways.
That's the beauty of it, right? There's always something new to learn and explore.
So to wrap things up, what's the one key takeaway you want our listeners to remember about time cycles?
That they're not some magic formula that guarantees profits. They're simply a tool that can help you make more informed trading decisions.
Right. You still need to do your own research and manage your risk carefully.
Absolutely. But if you use time cycles wisely, they can give you a real edge in the markets.
Well, this has been another incredible deep dive. I've learned so much, and I'm sure our listeners have too. So thank you for sharing your expertise with us.
It's been my pleasure. And to all our listeners out there, remember, the market is a complex beast. But by understanding the rhythms and cycles that drive its behavior, you can become a more confident and profitable trader.
So until next time, keep those charts open and happy trading.
That wraps up our deep dive into time cycles and how they can help you anticipate market movements. Up next, we're diving into market sentiment analysis, where we'll look at how to gauge the collective mood of the market and use it to enhance your trading strategy. But before we continue, a quick reminder. If you're enjoying the show, please support us by subscribing and sharing the Brewing Trades Podcast with other traders in your network. Your support helps us keep bringing you valuable insights each week. All right, let's get back to it with Maya and Remus on market sentiment analysis.
Hey, everyone, and welcome back. We're diving deep into market sentiment.
Yeah.
The collective gut feeling of the market.
Right.
So we're going to try to figure out the emotions and biases of all the traders out there.
Yeah.
All the fear, the greed, the optimism, the pessimism.
Yeah.
Because all of that really drives market activity.
Absolutely.
We've got a ton of research articles, all that stuff to unpack. And hopefully by the end of this, you'll be able to read those signals, use sentiment alongside other analyses, and, most importantly, avoid getting swept up with the herd mentality.
Yeah, it's incredible how much psychology plays into all of this.
Right.
Market sentiment goes beyond just the numbers, right? We're trying to understand the motivations behind the decisions people are making.
Yeah, totally. It's like you see a crowd running for a door, right? You just follow them blindly.
Right.
Maybe there's a huge sale on the other side, or maybe there's a fire. You know what I mean?
Yeah.
Understanding market sentiment can help you figure out which one it is.
Exactly. You can potentially anticipate, those big shifts, validate your other analyses, and avoid those risky decisions that can lead to losses.
Okay, so let's talk about how we actually measure this, vibe of the market, these sentiment indicators. What can they really tell us?
So each indicator is like, a different lens to look at the market psychology. Each one offers a unique perspective, and by combining them, we can get a much more holistic understanding of what's driving behavior.
So it's not just one magic number.
No.
It's about, putting those clues together.
Right.
So what are some of the key indicators we should be looking out for?
Well, one of the most popular is the COT report, which stands for Commitment of Traders Report.
Okay.
It gives us a sneak peek into the positions held by major players in the futures market, including the commercial hedgers, large speculators, and retail traders.
Hold on, wait a second. Who are these commercial hedgers and large speculators, and why should we care what they're doing?
So commercial hedgers are companies that deal directly with that underlying asset or commodity.
Okay.
For example, a big agricultural company might use futures contracts to hedge against price swings in like corn or wheat.
Right.
They're not really trying to make a profit by speculating.
They're just trying to protect themselves.
They're not managing risk.
Okay.
Now, the large speculators, these are often like hedge funds and investment firms.
Right.
They're more focused on profiting from the market moving up and down.
Oh, okay.
They're always looking at trends, looking for opportunities to capitalize on price swings.
So we've got these industry experts, and then we've got the pros, the gamblers.
You got it.
So the COT report shows us which way they're leaning.
Exactly. It shows us the net positions held by each group, whether they're bullish or bearish on a particular asset.
Okay, so if we see that large speculators are, really betting heavily on the rise of a certain commodity, should we just follow them?
Well, not necessarily. It's really important to understand that even though large speculators can be very influential, they're not always right.
They make mistakes too.
Sometimes they get caught up in their own hype.
Oh, yeah.
So that's where understanding sentiment extremes comes in.
What are sentiment extremes?
So you know how like when everyone is convinced something's going to happen, it almost becomes like a self-fulfilling prophecy?
Right.
When sentiment reaches an extreme, whether it's like super bullishness or super bearishness, it often signals that the market is overextended and due for some kind of correction.
So it's like a pendulum swinging too far in one direction. It has to swing back the other way eventually.
Exactly. When everyone is super optimistic, prices have been going up, up, up.
Right.
There's not really much room left for more upside.
Yeah, that makes sense.
Hey.
So the COT report can help us identify these turning points by showing us when sentiment is reaching a fever pitch.
Precisely. It can be a very valuable tool for identifying potential reversals, especially when you combine it with other types of analysis.
Okay, this is super fascinating. But before we go too far, let's talk about another sentiment indicator.
Okay.
Retail sentiment data. I have a feeling this one might be a bit more unpredictable.
You could say that retail sentiment data tracks the positions held by individual traders, and it can often provide a contrarian perspective.
Contrarian, you mean like doing the opposite of what everyone else is doing?
Exactly. So a lot of times retail traders enter the market later in a trend after prices have already moved significantly.
Right.
And this creates a situation where extreme retail sentiment actually signals that a trend is about to reverse.
Oh, wow. So if like everyone and their grandma is suddenly bullish on a particular stock or currency,
Yeah,
that could be a warning sign.
it could be. You know that saying, if your taxi driver is giving you stock tips, it's time to sell.
Yeah, that's a good one.
Yeah.
Okay, so we've got the COT report giving us the insights on what the big players are doing, and then retail sentiment data can give us a heads up about, when the party's about to end.
Exactly. And these are just two of the many sentiment indicators we can use to,
Right.
understand the psychology that's driving the market.
This is incredible.
Yeah.
I can't wait to learn more about all the other tools.
Let's do it.
Yeah.
Let's dive in next.
Awesome.
Welcome back. We've been talking about, market sentiment and how to decode
Right.
all those little psychological cues that are driving the market.
I'm starting to see how these indicators can really give us an edge.
Right.
It's like we're learning to read the market's mind.
Exactly. We've talked about the COT report and retail sentiment data, but there are a lot of other tools out there to help us understand the market's mood,
Okay.
like volatility indexes, like the VIX.
The VIX,
Yeah.
the fear index.
The fear index.
Yeah.
That sounds intense.
Right.
What does it actually measure, and
Yeah.
why is it so important for,
Yeah.
understanding sentiment? The VIX measures the market's expectations of how volatile things are going to be in the short term
Okay.
in the S&P 500.
Right.
Basically, it shows how much uncertainty or fear there is
Gotcha.
surrounding the market.
Okay.
A high VIX reading means that traders are expecting big price swings to happen pretty soon.
Oh, so if the VIX is spiking, is that like, everyone heading for the exits?
Not necessarily everyone,
Okay.
but a rising VIX definitely shows a move toward risk aversion.
Okay.
Think of it like when storm clouds start gathering,
Yeah.
people are going to want to get inside.
Right.
When the VIX rises, investors move towards safe haven assets
Okay.
like gold bonds or cash.
Yeah. When things are uncertain, people want stability.
Yeah.
Makes sense. So how do we actually use the VIX to, make better decisions?
Well, the VIX can be a great way to figure out the overall market sentiment and to adjust your strategy based on that.
Yeah.
So, for example, if you're thinking about making a risky trade and the VIX is high, maybe be a little cautious, maybe even wait for things to calm down a bit.
So the VIX is like a barometer for how anxious the market is.
Exactly.
Got it. What other indicators should we be aware of?
Well, there are economic sentiment indexes, which, tell us how consumers and businesses are feeling.
Yeah.
One you've probably heard of is the Consumer Confidence Index.
Oh, yeah, I've heard of that one.
Yeah.
If people are feeling good about the economy, they spend more,
Yeah.
they invest more,
Right.
and that helps the economy grow.
Exactly. And that positive sentiment often translates into, bullish market sentiment.
Okay.
On the flip side, if consumer confidence is low, it could mean that people are worried about their money.
Right. Their jobs, the whole economy,
Exactly.
which could mean, less spending, less investment.
Yeah.
And maybe even a market downturn.
Exactly.
Yeah.
So economic sentiment indexes can give us clues about the direction of the economy and therefore the direction of the market.
So we can use these indexes to get like the big picture, the overall mood, and then use that
Yes.
to make our own trading decisions.
Precisely. Now, let's not forget about news sentiment analysis.
Oh, yeah. Analyzing the mood of the news, that's a thing.
Yes.
I'm still amazed that we can like quantify, something as subjective as sentiment. How does that even work?
It's really cool. It uses AI and machine learning
Wow.
to analyze tons of financial news, social media chatter forums
Okay.
to gauge the overall tone around a particular asset or market.
So it's like an army of analysts scanning the internet
Yes.
for clues about how people are feeling.
Right. These AI algorithms are able to pick up on those subtle shifts in language and tone
Wow.
and figure out whether the overall sentiment is positive, negative, or neutral.
Okay. So if the news is full of, positive stories about a company,
Yeah,
the stock price is likely to go up.
it could. Positive news sentiment generally correlates with increased buying activity and upward price pressure.
Right.
And on the other hand, a surge in negative sentiment can trigger selling and a price decline.
Wow. This is incredible. we've got all these tools to, measure the emotional temperature of the market.
Yeah.
But how do we actually put them into practice?
That's the question.
Yeah. How do we use all this to make smarter decisions?
Yeah, that's what we're going to dive into next.
Okay. So we're back and we're ready to put all of this sentiment knowledge into action.
Yeah.
We have all these incredible tools.
Right.
But how do we actually use them?
Yeah. It's like having a map and a compass,
Right.
but you still need to know how to navigate.
Exactly. So what are some of the strategies for using all this sentiment data to, make better trading decisions?
Well, one powerful approach is trend following.
Okay.
Remember the COT report we talked about?
Yeah.
By looking at the positions of large speculators, the non-commercials, we can maybe identify strong trends that are likely to continue.
So if we see that those big players are really long on a particular asset,
Right.
it could be a good time to jump in and ride that wave.
It could be, but it's super important to be strategic about trend following.
Okay.
It's not just about blindly copying the institutions.
Right.
You still have to look at other factors like technical analysis,
Yeah.
fundamental analysis, and of course, your own risk tolerance.
Right. It's about using sentiment as one piece of the puzzle, not the whole thing.
Exactly. Now, on the other side of trend following, we have contrarian trading.
Okay.
This strategy is all about going against the crowd,
Interesting.
especially when sentiment is at extreme
Okay.
in range-bound markets.
Gotcha. So if everyone is freaking out and selling an asset,
Right.
a contrarian trader would see that as a buying opportunity.
Exactly. The idea is to buy low when everyone else is selling or sell high when everyone else is buying.
Okay.
Of course, this requires a deep understanding of how the market works.
Right.
And the ability to get, spot real sentiment extremes, not just little bumps in the road.
So both trend following and contrarian trading can work,
Right.
but they require different skills.
Yeah, and different levels of risk.
Right.
Okay.
Okay, let's talk about a real world example.
Okay.
Let's say we're looking at the Euro USD currency pair.
Right.
We check the COT report and see that large speculators are net long,
Mm-hmm.
which suggests that, institutions are bullish on the euro.
Right.
But then we look at retail sentiment data and it shows most retail traders are short on Euro USD.
Okay, interesting. So we've got the big players betting on the euro
Yeah,
and the smaller traders betting against it.
exactly. That sounds like a classic contrarian setup.
It could be.
Yeah.
Now, to confirm this potential trade, we can look at technical analysis.
Okay.
So let's say the Euro USD price is near a key support level
Mm-hmm.
and we see bullish divergence on the RSI.
Okay.
This gives us more evidence to support that long position in Euro USD.
So we've got the institutional bullishness from the COT report,
Yes.
the contrarian signal from retail sentiment,
Uh-huh.
and the technical confirmation from the price action and the RSI.
Right. It all fits together.
Like all the pieces of the puzzle are falling into place.
Yeah, exactly. And that's what sentiment analysis is all about.
Yeah.
It provides an extra layer of insight into, the psychology of the market.
Right.
So you can make smarter, more strategic trades.
But even with all of these tools and strategies,
Right.
sentiment analysis isn't a crystal ball.
No, of course not.
It has its limitations.
Like any type of analysis,
Yeah.
sentiment indicators can sometimes lag.
Mhm.
And even extreme sentiment doesn't always mean a reversal is coming.
Right.
You always have to look at the bigger picture and use sentiment analysis alongside other types of analysis.
So it's about using sentiment to understand the market better, not to replace our other tools.
Exactly. And the more you practice, the better you'll get at reading the market's mood and making those smart decisions.
That's like learning a new language, the
Yep.
language of the market.
Exactly.
And the more fluent we are, the better we'll be able to, navigate its complexities.
I love that analogy.
Yeah.
So to our listeners out there,
Yes.
keep exploring the world of market sentiment.
Yeah.
Experiment with these indicators.
Mm-hmm.
Learn how to read between the lines.
Right.
And, see for yourself how understanding market psychology can really change the way you trade.
Absolutely. And remember, knowledge is power.
Yes.
The more we understand about how the market works, the better we can face its challenges and, grab those opportunities when we see them.
I agree.
Keep diving deep, everyone.
And that brings us to the end of today's episode of the Brewing Trades Podcast. We hope our deep dive into time cycles and market sentiment analysis gave you new tools to strengthen your trading strategy. If you found this episode helpful, don't forget to subscribe and share the podcast with other traders. It really helps us keep delivering more insights every week. Thanks for tuning in, and until next time, trade smart, stay informed, and keep brewing those trades.